Corporate balance sheets hold highly volatile assets and liabilities. While professionals frequently treat IFRS 9 as a fragmented checklist of valuation rules, misapplying its logic can destabilize the reported stability of an entire entity. Contrary to the industry label of a fair value manifesto, the standard does not force every asset into market pricing. IFRS 9 functions as a strict architectural framework, mapping legal contracts and management behaviors to the amount, timing, and uncertainty of future cash flows. Mastering the standard requires a system engineering mindset. The 5 logical blocks on the right show a rigid hierarchy. It begins with scope and recognition, providing data for classification. This determines measurement and expected credit losses, leading to hedge accounting and derecognition. Executing these steps out of sequence introduces systemic errors. An incorrect conclusion at the scope stage cascades through every subsequent measurement in the financial statement. The standard presumes broad inclusion. Every financial instrument is in scope unless it meets a targeted exclusion, like subsidiaries or employee benefits, governed by specialized models. Yet excluded items often feature selective re-entry, allowing IFRS 9 to retain authority over specific risk components. For example, an equipment lease follows IFRS 16 for its main accounting, but the impairment of that lease receivable is pulled back into the IFRS 9 credit loss framework. This boundary logic is especially critical for contracts involving physical commodity supplies. A genuine physical procurement contract stays off the financial instrument balance sheet through the own use exemption. That exemption is overridden the moment a contract permits net cash settlement. Behavioral evidence carries the same weight. If an entity has a history of settling physical contracts for a short-term cash margin, the standard ignores the legal title and treats the arrangement as a fair value derivative. By prioritizing economic behavior over legal labels, the scope rules prevent trading activities from being hidden behind physical procurement language. Identifying the recognition trigger is step 1. An instrument enters the balance sheet when the entity commits to the contract. This activates day 1 measurement. While starting at fair value, transaction costs are capitalized for amortized cost, but expensed for FVTPL. In active markets, this timing becomes complex due to the lag between executing a trade and final settlement. The standard allows trade date or settlement date accounting, each with specific consequences. For amortized cost assets, market price changes during the delivery gap are ignored. However, assets held at fair value must recognize those fluctuations immediately, before delivery. These mechanics establish the permanent baseline for all subsequent impairment models and fair value calculations. Classification follows a strict anatomy-driven system, replacing the older reliance on management's stated intent. Assets are processed through 2 filters. The first is the business model assessment. This filter tests operational reality. It looks past narrative claims to examine how portfolios are actually managed, specifically focusing on sales frequency and manager compensation. As the diagram indicates, the final gatekeeper for amortized cost is the SPPI test, verifying if cash flows represent solely payments of principal and interest. Interest has a narrow definition here, covering only the time value of money, basic credit risk, and a standard profit margin. Any contract featuring equity-linked returns, leverage, or commodity triggers fails this test. Failing SPPI forces the asset into fair value through profit or loss, immediately exposing the income statement to market movements. This process effectively strips away cost-based accounting privileges from instruments that carry complex or hidden risk exposures. The conceptual shift to a forward-looking risk assessment model marks the most significant and transformative change in the entire financial reporting standard. The previous model waited for a default event to occur before recognizing credit deterioration, often hiding losses until it was too late to react. The expected credit loss model integrates these forward-looking assessments as a core accounting element, addressing the delayed loss recognition of the past. It uses a 3-stage model. From initial recognition, every performing asset carries an allowance for credit losses expected over the next 12 months. The model shifts when there is a significant increase in credit risk. Once this trigger is met, the asset moves to stage 2, requiring the entity to recognize expected losses over the entire remaining life of the instrument. This calculation requires weighting various scenarios using reasonable and supportable macroeconomic forecasts. This wires treasury and macro risk forecasting directly into the face of the financial statements, creating a fundamentally prudential reporting model. IFRS 9 serves as the central logical processor, but it functions within a wider ecosystem of standards. It relies on IAS 32 to establish the legal boundary that separates a financial liability from an equity instrument. It determines when to use fair value, but then outsources the actual measurement hierarchy and mechanics to IFRS 13. Finally, the output flows into IFRS 7 to provide the qualitative and quantitative risk disclosures that make these numbers interpretable. Mastering IFRS 9 requires moving beyond isolated compliance checks to understand this complete architectural flow, from contract scoping and classification filters to forward-looking risk models and ecosystem disclosures.